Hello everyone. Today we're going to continue with the fifth chapter of Financial Markets and Institutions, which is about commercial banking. So let's first talk about what commercial banks do. Commercial banks collect deposits from savers and make loans to borrowers. So in a way, they facilitate transfer of funds from surplus units to deficit units, from the investors to borrowers, from the lenders to borrowers. So they create money by making loans, and they create credit. They make credit against deposits through the money multiplier. So in a way, they attempt to diminish risks by diversifying loans and investments. So by lending money to a large diversified base of customers, they help to diversify risks. One thing to keep in mind is that regulation is very important in the banking sector, since banks need to maintain public's trust in order to ensure sustainability of deposits. Another important feature of commercial banks is that another important function is that they help to reduce asymmetric information problems. Those problems, namely adverse selection and moral hazard problems, arise because the parties involved may have different levels of information. For example, banks may not have full information about the credit worthiness of customers, so in a way they cannot distinguish between those customers, and even high credit worthy customers are prone to high costs because of these adverse selection problems. And moral hazard arises when lenders use the credit they use for different purposes, rather than, for example, to invest in their businesses. So you may find some detailed information in the book about those asymmetric information problems. And thanks to the economies of scale of commercial banks, they can provide lending at a lower cost. This is due to the efficiencies in gathering information on the risks of borrowers and the subsequent monitoring after they create credits. As we mentioned before, they diversify risks by spreading risks across a large number of borrowers, and by issuing standardized securities, they can reduce the cost of transactions. And they ensure a regular flow of liquidity through deposits. There are some different business lines in commercial banks. Most important of them are retail banking and corporate banking. Retail banking services are offered to individuals and very small enterprises, whereas corporate banking services are offered to large businesses. Retail banking services include credit cards, consumer loans, and mortgages, while corporate banking services include overnight loans, short-term loans, and large commercial and industrial loans. So, what are the main sources of funds and uses of funds of commercial banks? In fact, liabilities and the capital of commercial banks constitute the main sources of funds for commercial banks, whereas assets constitute use of funds. And the primary source of funds for commercial banks is deposits, whereas the primary use of funds is the loans they make to their customers. So we can consider the demand deposits, checkable deposits, saving deposits, time deposits, different types of deposits, and also short-term borrowings of commercial banks in the interbank money market, as well as borrowings from other financial institutions, and as we mentioned, the equity, the capital of the commercial banks as the sources of funds. And the uses of funds consist of commercial loans, as well as consumer loans and short-term loans extended in the interbank market to other commercial banks. Commercial banks may also extend loans through repurchase agreements. And since commercial banks need to keep some required reserves against deposits, this is another use of funds. And also some excess reserves could be held in the central bank. The currency in the ATMs and deposits with other banks, also assets invested in marketable securities, constitute the main uses of funds of commercial banks. What about the revenues and expenses of commercial banks? In fact, the interest revenue that arise from the loans granted, and as well as the commissions and fees of commercial banks, are the main sources of revenues. So, as I said, when commercial banks grant loans, they charge some interest. Also investing in marketable securities, providing credit cards and debit cards, servicing deposit accounts, providing financial advice, and providing wealth management services, and also carrying out foreign exchange can generate interest revenue and commissions and fees for commercial banks. How about expenses? As commercial banks collect deposits, they have to pay some interest expense to the deposit customers. There are also some operating expenses and costs of commercial banks to carry out their operations. So, as I said, collecting deposits lead to the main interest expenses, as well as borrowings from borrowings in the interbank money market, or borrowings from other banks or other sources. And when commercial banks provide financial services, as I said, they need to incur some operating expenses and costs. There could also be some expenses for loss provisions as well. The risk management of commercial banking is an important topic in practice and in theory. There are various types of risks that commercial banks assume. We can classify them as interest rate risk, liquidity risk, credit risk, and operational risk. These are the fundamental risks that commercial banks face when they function in the financial markets and institutions. The interest rate risk arises from the different maturity structure of the bank's assets and liabilities. And the liquidity risk, in fact, is not being able to meet cash needs by selling assets or raising funds at a reasonable cost. When if commercial banks cannot fulfill their obligations, the liquidity risk arises. On the other hand, the credit risk is the risk of changes in the economic value of the bank's assets due to some unexpected changes in the creditworthiness of counterparties. Another risk item is the operational risk, which can be defined as the risk of damages caused by human and technological factors. Let's take a closer look at interest rate risk. As I mentioned, it arises from the imbalance between maturities of assets and liabilities. So that's the main cause of interest rate risk. There are some measures, different methods to measure interest rate risk, such as gap analysis and duration analysis. In fact, falling market interest rates implies increases in profits and net worth of commercial banks, and vice versa, meaning rising market interest rates implies decreases in the profits and net worth of commercial banks. In order to hedge interest rate risks, banks may use financial derivatives. As I mentioned, the liquidity risk can be defined as the inability to meet short-term financial demands in case of sudden unexpected cash outflows, such as large deposit withdrawals or large credit disbursements. Liquidity risk is very important since illiquidity of commercial banks may lead to reputation risk if they cannot fulfill their obligations, financial obligations. This may lead to reputation risk of commercial banks and even to bankruptcy. So bank managers must be very careful about ensuring sufficient liquidity in case of emergency situations. The credit risk arises because of asymmetric information problems. As I mentioned before, commercial banks may extend loans to risky borrowers, which is related to the adverse selection of commercial banks, and borrowers may use the loans for purposes not intended by commercial banks, which is related to the moral hazard. In order to control credit risk, most often, commercial banks use risk limits and risk delegations. So these are the main methods used for managing credit risk. Other methods of managing credit risk include diversification, making loans, for example, to a diversified base of customers, making commercial credit analysis, taking collaterals against loans, monitoring of customers after granting loans, and putting some restrictive covenants in the contracts, and also establishing long-term relationships may help banks to manage credit risk effectively. As I mentioned, the operational risk arises from some human factors or technological factors. So these the sources of operational risk include infidelity of human resources, IT crashes, human errors, software breakdowns, fraud, electronic theft, adverse natural events, or robberies. So that was a quick review of Chapter 5, Commercial Banking, the basic concepts about commercial banking. And we'll continue with the remaining 2 chapters soon.